Well, welcome everybody to the Locking Your Success weekly trade and market update for, what is it, March 10th, 2014. One thing I'd like to mention before we get going is that we're going to start posting these on SMB, and they have special rules and regulations which they have to go by, and therefore we're going to be calling all of our trades hypothetical going forward so that we can do that. They're just not allowed to post live trades. So if that's the case, I may have remarkably similar trades on. However, the trades here are actually going to have hypothetical pricing in them, and they're going to have to be just altered slightly from real. So just know that going forward. And as is normal, we're doing this for educational purposes only. We're not broker-dealers or financial advisors, and we're not making specific trade recommendations. Also, the risk of loss in trading options may be substantial, so please be aware of all your risks prior to placing any trades. And if you're watching this on SMB or YouTube or somewhere else, please check out our programs, M3 Bearish Butterfly ROCK group coaching, and the Trading Triangle program, as well as the M21 program, which should be out hopefully in the next 3 weeks or so. They're working hard to get this edited and out. And make sure you come on in, join our mailing list, get the free report, 7 Secrets to Become a Successful Trader, and sign up for this weekly webinar. And stay tuned for our upcoming programs. Okay, let's jump right in, and we'll take a look at what's going on in the market. We had, last week I was saying that the market really wasn't acting technically correct, and that it was a bit dangerous to be in a position that was close to expiration. And I said that mainly because we're likely to get a violent move, unpredictable move off of this level. And I was saying that if the market started acting correctly, the SPX should hold an 1850 level. And from that 1850 level, it should basically just continue to the upside. I also said that if the SPX happened to have a failure of the 1850 level, it should move down fairly aggressively. And I added that if it failed and sat there, that would basically tell us that the market's continuing to act normally, and we'd have to wait for some sort of a decisive move one way or the other. Well, what ended up happening is the SPX did break the 1850 and it just sat there, which is definitely a warning sign that we're going to break back up on Tuesday. And if you look at the charts here, we had a fairly good idea of where we're going to break to. So we broke down under this area on Monday, and then we had the gap up and went right up to the top of this. So we're kind of setting in what we call a broadening pattern here, which is an area where the buyers and sellers tend to get more and more aggressive at basically a more primary support or resistance area. So from here, this means that the market is likely going to remain unpredictable, and this support level isn't terribly valid. So normal move from here, it wouldn't be abnormal to see us come back down into the 1835 level and ignore this area. I'm going to assume, however, going forward that the market is going to return to something a little bit more normal than this. And even though we're a little bit unpredictable, I can still say, what's most likely to happen here. It's just that when I do say that, my confidence level is going to be a bit down. So what I'm looking for here, and this is an hourly chart, by the way. What I'm looking for here is I would like to see the SPX come down and run to the 1865 level or so, maybe even a touch lower than that. Hold this channel and continue up. Then from there, this makes sense to us, and the market should continue to climb. What I think is more likely going to happen is we're going to break this level and probably just retest the 1850 level and remain sideways. I'm calling this area, I'm thinking that we're going to come into this area here for expiration week. And to get there, again, come down here, maybe take a bounce, but eventually break this channel, have 1850 hold, and come into this area for expiration. That is what I think is most likely going to happen. And again, my confidence level on that isn't terribly high, because the market is still in this broadening pattern, and as long as we're in this, we're going to be a little unpredictable within this range. All right, so if that happens, it's likely going to bring, I'm just going to go into a yearly chart. it's likely going to bring the Russell, let's go into the Russell, down to around 1180 level, and possibly all the way down to this purple trend line again, and run sideways. I'm still liking this red area for exploration. If the one fly in the ointment here, which we've kind of talked about, is the Dow. I'm expecting the Dow to come up and retest 16.6. Came awfully close to that actually on Friday. And if you look at the hourly on the Dow, we are technically at a resistance area right up in here, right? We just came in, we touched this resistance area right in here, and we rolled off it, which isn't unexpected. However, I would still think that we're going to push up to 16.6, which may drag things a touch higher. If that doesn't happen and we just continue down, that wouldn't be a terrible surprise either, because like I said, we are in a resistance zone. So if we were still down here at the 16.4, I'd be thinking, well, the market is going to be going up. But right here, this could go either way. And the Nasdaq's just been, we had that gap up, and it's been pretty much dropping out towards the end of the week. And we're sitting here. So Nasdaq, I still believe, is going to run sideways as well and run into this level here. So in general, with the market, our confidence level isn't high. Sometimes you can look at this and say, hey, the market's acting technically correct, and this is what it's going to do. This is one of those situations where it's kind of not, and we can still kind of come in here and make some calls, but that's just our confidence level's a little low. So that's what I'm thinking for this week, is a touchdown here back into the 1180 level, and then remain sideways. If the Dow runs for its highs, we may retest these highs here again. I wouldn't expect us to go terribly higher, but like I said, the market's been amazingly resilient, and the bulls have been coming in and just keep pushing us higher. So that's what we got for that. So let's take a look at how we did last week with our positions. We had a 30-plus point move up on Tuesday with a Dow. Before that, we had a support level break. Again, I was talking when we had that support level break that would, if the market sat there, that would be an unpredictable break, and it may whipsaw on us. So, and that's exactly what happened. So if you happen to adjust down this day here because you had some sort of a level break, then you definitely got beat up on Tuesday. But let's take a look at what I have on, and we'll start with the M3 trade. Now, this here on Monday, I'll show you the position we're sitting in on Monday, was looking a little bit like this. We were way outside the tent, and if you remember, I was reluctant to roll up on the market, even though we were kind of past 10 points. We never really had any sort of a Greeks problem, so there was really no reason, no sense of urgency there whatsoever to do anything. And I wanted to stay back here because I thought the market was unpredictable, and I didn't know which way it was going to go. And this is the safest position that I can really think of. I mean, if the market comes down, I have my tent back here. My delta's a little flat, but I can usually handle that. I have a little bit of time to deal with a down move. And if the market shot up, then that wasn't necessarily an issue either. So if we come to the end of Tuesday, we got that really big move there. And here's where we ended up. Positions up slightly, and again, I chose to sit here. And the reason I chose to sit here is because I don't necessarily want to roll this position or get too crazy when the option prices are nuts, because we had a 30-point up day. We're up well over 35 points at one point during the day. And I just didn't want to do that. Do I have a problem here? No, I have no problem whatsoever. The market can sit here. If the market continues to go up, that's not an issue. My biggest issue if the market settles back and sits, which is pretty much what happened, but I'll show you what happened on Wednesday. So no urgency necessarily to do anything this today. I know I want to adjust up now because we went up so far, but there's not an urgency to it. So I decided to let it wait, and I waited till Tuesday. And then I made my major roll here. I ended up taking this position up to, I think I rolled the shorts, these 1120s all the way to 1160. Let's see what the position looked like here at the end of the day on Wednesday. Right now my primary shorts, they went from all the way from 1120 to 1160. I went 40 points because I was behind the market to start with, and now the market made this fairly aggressive move. So I ended up not doing 20 but 40. And I put in my verticals here to offset my delta, and I come to like a minus 36 delta and a position sitting like this. So nice, healthy looking M3 trade. Gamut trend's perfect. We got some nice downside room. And this is pretty much how we went into the rest of the week. So we come in here to Friday, and we're starting to gain a little bit of value here. We'll have to see what the market does going forward, but if it does what I think it's going to do and we remain relatively sideways and hold this 1180 level, this should actually end up being a fairly good trade for the month. So that is what the M3 in March looks like. The next trade I'd like to quickly go over would be the ROCK trade. If you remember, we had entered this as an M3 because we were having, that's what our guidelines basically told us to do. Monday morning we were sitting in a position that looks something like this. Very, very similar to, let me switch over to the ROCK trade. That would be nice. This is going to be very, very similar to our other trade, right? So Monday, we were looking something like this. This market, this one's down more than the regular M3 trade was at this point, mainly because it has 2 calls on it. The 2 calls are more of a drag on the trade, and it gives you more positive vega, and we get this situation where the market just kind of sits here. The 2 calls tend to hurt you rather than having the vertical spreads while it's sitting here. However, once the market actually starts moving, they make a big difference. So here's the position we were in the ROCK trade. We were actually a little bit vulnerable to the downside here on Monday after this down move, if the market continued down, but not terribly so. And we're definitely within the trade guidelines. We had the jump on Tuesday, which put us in this position here, very similar to our other trade. I'm a little bit more concerned about this one, again, because my vega is more positive and my theta is more negative because of the 2 calls versus the wider verticals. However, I still let this sit till the following day. And since this is a ROCK trade and not an M3 trade, we configured this back over into a ROCK position. So I'm sitting here Wednesday morning like this, with a 1140 butterfly and a couple of calls and some verticals, and I shut that down and went into this position by the end of the day. Let's show you. And I can show the T-log on that if you'd like. So here's basically all the moves that were put in on Wednesday, which is a fairly significant adjustment, right? We're basically closing the position out and restarting as a ROCK trade. So the new position comes in at 10 1180 butterflies and 7 1220s, puts us at approximately exactly minus 180 delta, very close to minus 180, and we go through that, and we're up a little bit of money here by the end of the day, because I did this earlier in the morning, obviously, around noontime. And on Thursday, when the market continued up, we started hitting our delta guidelines relatively quickly, so I scaled into the rest of these 1220s. So if you go to the end of the day on Thursday, this is going to look like this. Basically looks just like a condor with 40 points between our strikes, and there were no further adjustments. So if we come into Friday, the position is up about 2,400, and we're pretty much right in the center. It looks really nice. So from here, if the market decides it wants to continue up, then we scale back into the 1240s. If the market decides it wants to come down hard, we roll back into a cap position and we ride it out for the rest of the time. And that's what we have for the ROCK trade. Let me think here. What other positions did we have on? We have on, an April V Condor. So let's take a look at what that looks like. This here, remember the March V Condor got beat up because we had a really, really hard down move. This V Condor is getting beat up because we had a really, really, really big up move. So here, from a T-log standpoint, what I did this week is on the 5th, all I did is I bought back 2 more of these 1240 calls. This position currently looks like this. Let me back this out. We are continuing to buy these back. Again, this got whacked on the downside. I had to buy back a put, and now I'm getting hit on the upside. It's rare for a V Condor to get hit on both sides. It's just telling us the volatility is really good. Standard deviation. Okay, I'm sorry. I have a question. It says, it says first one says showing the T-logs really helps. Okay, thank you, Ray. And I'll try to do that more often, and just remind me if I forget to. And could I please turn on a standard deviation line on the analysis graph once in a while? Okay, yeah, so I'm assuming you're talking about this graph down here. If we look, click on the expiration line, right, we can see the standard deviation graph here. And I will go back to the ROCK trade too, yes, and turn on the standard deviation line in the ROCK trade. Okay, great. So here's the standard deviation line on this trade. This should be fine. Very unlikely this is going to be a problem. The market backs down and runs sideways. As soon as we get back into this area here, we will start selling these or widening this out and actually bring some profit in here. Not going to be a banner month, but it still is a very, very good possibility this will be a profitable month for this particular trade. Let's go back to the ROCK trade. I'm asked 2 questions here. One was, what was the profit and loss before it was changed over? So let's go back to the March ROCK trade, and we'll look at the T-log. We did this, so I'll have to go to 12 o'clock. So if I go to 12 o'clock on Wednesday, I think it may have actually been drawn down money possibly at that point. Yeah, so it's about flat, about 196. Right, and if we run to afterwards, looks like we're about 105 afterwards. I mean, execution on these, the way that I tend to do them, I don't really take on any delta risk, and usually I can execute these at or better than mid prices. I'll do it using various condors and stuff, keeping my delta flat and riding the market back and forth a little bit. So normally I can do that. So immediately before this, it was showing up about 200. Afterwards, about 105. And of course, by the end of the day, what tends to happen is as soon as as soon as the market slows down, value tends to come into these, which is why I really like making this adjustment, because by being small in an M3, when the market took off to the upside, it ripped all the value out of the butterflies. And then when it settled back a little bit came in, but then I increased my size here, and if the market tends to sit, this gains value very, very, very quickly. So that being the case, but even by the end of the day, this is just showing 866. And of course, Thursday and Friday, particularly on Friday, it looked like the market was going to come back at us, and that being the case, you tend to get a pop in the T+0 line here, which is basically what happened by Friday. So that's back at the ROCK trade. And this is what it looks like here. Now, if the market really starts moving up again, this will depress down relatively quickly. A harsh down move would depress it down as well, but if we only get 5 or 10 points today, then this will probably still gain a significant amount of value relatively quickly. All right, so we have we went over the April V Condor, and last thing we have is the April Bearish Butterfly, which I'll go back to Monday on this also. I'll show you where we sat. And you'll really see the value pop in the bearish butterfly, right? Because I'll show you before the adjustment point. So Monday we look, nope, wrong account. Let's go. So this is down like $930 coming into Monday after this down move. Here's what the position looks like here. And Tuesday, of course, we got the really big up move. Bearish butterflies, I really like scaling up on these when the market has a really big move. And again, the reason is this butterfly, when the market takes off, just gets massacred. And also the butterfly that you're buying is completely massacred also. So going back, sorry to switch subjects. Sorry to switch subjects here, but so this is the way we were sitting here at the beginning. If you remembered right, I did have delta theta issues, and this should have really been rolled up to 1150. You know, why don't I like to do that with 1/3 on? I don't like to do that with 1/3 on because a big move to the back to downside, I'm going to gain my money back more quickly. If we get that, I'm a whole lot more protected to the downside. And if we get a big move to the upside, I actually lose less money than I would have had I rolled up, because this is a less expensive butterfly than the one that's 10 points or 20 points higher. So I don't mind sitting here, you know, waiting for the market to work itself out till we get some sort of a significant close over 1190. And you know, however, I do know that when I do exceed 1190, I'm going to want to roll up and add. And we were talking about that earlier, so that's what we did here. We got the significant move over 1190 on Monday, and I did take advantage of this intraday. Let me just show the T-log. On Tuesday, I just want, okay, so on Tuesday I didn't do anything to us till towards the end of the day, so we'll go to 1500 on Tuesday and show you where we were sitting. All right, so we get this big move up 33 points. This butterfly gets destroyed. It's down $4,500. This is what our position looks like here. Also, the value, not only is the value in this very low, but your value in your 1170s and your 1190s are going to be relatively low also. So it's a good time to double size. So I come in here and I roll this to 1170 and I add the 1190s. And at the end of the day, the position looks like this. Right, and we're actually increasing our negative delta a bit here. I'm still within my guidelines on the delta theta, I believe. Yeah, it looks like it. However, like I said, I'm not really concerned because it's likely the market's going to slow tomorrow and the profit and loss is going to come back. So just going to Wednesday here, when the market slows down, you get a significant pop in your pop in your T+0 line, and my losses are cut in half. So here, no other adjustments were made, and if we run till Friday, this thing's only down about $1,500, and the position looks like this. So that is, you know, if we get this down, 5 points down today, this will actually be up a significant amount of money. If I was in and I wanted to break from the guidelines, I could protect my profits at that point. So if I come back and I'm up $5,000 or $6,000, if I wanted to, I could protect these by widening out and allowing myself less gamma and do something like that. But this is the position we're in, and again, this trade's just going to follow guidelines. All right, that's all the positions we have on. I do have a question about it says with the small bid-ask in IWM and SPY versus some hard-to-get mid in RUT, may there be an advantage to using IWM even though the large number of contracts in reflecting commissions? One thing you have to remember is when you're dealing with IWM or SPY versus the Russell is you're looking at it's 10 times the cost. Therefore, if you get 5 cents of slippage in the IWM, for example, that's like getting 50 cents in the Russell. So, you know, you got to compare apples to apples there. If you get a 10-cent slippage in an IWM position, then that's equal to $1 slippage in the Russell position. And second, you know, mid prices don't really mean a whole lot anyway, because mid prices fluctuate all over the place. You have to do a comparison of your synthetics and kind of get an idea where this thing's actually going to really trade at, watch it over a bit of time. So I don't say price is something, how do you actually calculate slippage when mid-price isn't really real? So you kind of have to go in and calculate, and we have methods to do this within our programs, but calculate what the mid-price really should be and then trade off of that. But yeah, if the reality is if you're trading IWM or SPY, you're probably going to get about the same amount of, not the same dollar amount of slippage, but the same amount of percentage of slippage. So there really, with the additional commissions on top of that, there really isn't much of an advantage to doing that, because you're paying, instead of paying $1.50 for, you're actually paying 10 times that, right, or $15 for commissions versus $1.50. So I have no reason to go to the IWM. There's just too many commissions there. All right, well, I think that's all we have, everybody. I think that's it. I just want to make sure I didn't miss anything. Thank you, everybody, for joining me today, and have a great week trading, and we'll talk to you next week. Goodbye.